Good afternoon and welcome to the FX wrap up. And we're looking here, and the euro has really come under some pressure. We're seeing the dollar push higher. Now, we already know what happened in the G20, and there was just a cessation as far as any hikes, any further tariffs. But if you want to know what's happening with the euro, we'll go on and switch in here to another screen. Right here, you can see it's all about the bund. The bund is what's pressuring the euro lower. As I mentioned, is on face is that the euro basically, is trading as a de facto in a sense for the dollar, in the sense that the euro comprises 56.4% of the dollar. And we saw the euro, and it had taken a dip. We saw a rally back. Actually, saw a strong rally back all the way up to around 1360. Our actual intraday bias charts resistance was 1368. But why did the euro start to slide? Well, because we saw the bunds, which is interest rates on German 10-years, fall even further. These are all-time lows, and we've always talked about that, or I've talked about it way in the past. One thing I used to do when I used to trade the euro more actively, we'd see great swings intraday. We haven't seen that many. We're starting to see movement now, but the kind of swings we would see, I would always say, take a look at what the bund's doing. If the bund is breaking the new highs, obviously the pressure is going to be on for the euro to go lower. And the reason is because of the interest rate differential. So when you're looking at if interest rates are continuing to fall now, most are expecting to cut this next month with the Fed. Key's going to be whether it's going to be 25 or 50. Most believe it's going to be 25 basis point. But in the meantime, the dollar already had the momentum going with it. And then on top of that, you see bunds going to all-time highs. That really put the pressure on the euro. And put the pressure on the euro, it did indeed. And you can see this euro just really coming apart here. Let's go on to the main screen so we can get an idea of where we stand from a perspective standpoint. Well, I always, for me, I don't look at 4-hour charts. I look at 2-hour charts. And so I'm looking at the 2-hour chart here in the euro, and we're at a pretty key level here, 1285. You can see here where the market, if you look further back, the market run into a little bit of trouble. And this almost worked as a little bit of a support. And then we came down here and it broke it. Then it was a little bit of a resistance. They challenged it, came back. Then on the way back up, we struggled it. The more touches you have, someone was just asking me, Brad was asking me in the chat room. He said, "Hey, what's the significance between these thicknesses of the of your levels?" And I was saying, because I was getting ready to go into the webinar, so I didn't have enough time to go into a little bit more discussion. But I said it has to do more with the amount of significance or touches. So I'll give you an example. Look at this 1285 here. Now we're looking at a 2-hour chart, so it's not a daily. But look at on this 2-hour chart, you certainly see where we had already run into trouble before here on this 1285. Yeah, it's overshot it, but you can see here it's been an area where the market really puts up a fight between bulls and bears. And we come down here, and what do we find? Make it up to 1343, where we come back down here, and where do we find some support? 1285. Remember, we already run into this area right here with the body closes. And like I said, I put my resistance and supports at the body closes, or what I call touches, as opposed to the high and the low, because you can see here's this low. Now, as the market comes down here, it doesn't really find more support until it comes down here and starts touching with these bodies. So what I'm referring to is that when we came down here, you can see the market had already been here at 1285. We came down here at 1285, came through it, tested again above it, again above it. It's not like this is a 5-minute chart. This is a 2-hour chart. So we're trying to challenge once again to get above the 1285. We can't get above it. We slide on down. We run back up here, and where they start to find trouble at? 1285. So it has more significance because it has more touches. Now, when I have a single one, it may just be that there was one, as I told him, one incident or two incidents where it has some support or resistance intraday, but not as much. So you would expect the market to make a stand here at this level. The same thing we saw here at the 1324. You see that? The market came down here. We challenged it. We tried to hold on. We rallied up. We tried to hang on. obviously the pressure of the Bunds was too great, not to mention also anybody that is long. I myself put on a long this morning. I'd scalped out. I put in a long when I was on the webinar at 1324, jumped out, but I turned around and got back long again thinking, okay, we're going to try and hold this area. But the pressure from the Bunds was too great. And I mentioned that in the chat room. Someone was asking me about that. And I said, hey, look, when it was trading, it already rallied up and it's trading back down here. And I bought it on the way back down. And I said, hey, look, the euro's going to have some trouble with these Bunds being where they are. And the Bunds have already pushed even, further higher rates lower. And we have a lot of people that have been long. Not a lot of people, but a lot of big players are looking for an extended move in the euro. So we're pressing those stops. And so when you go in and put in your trades, you want to look at what not only your stop is, but what your stop is. Is it based on a 15-minute chart, or is it, and I'm not trying to be facetious, is it based on a 2-hour chart, or are you looking at a daily? Because the shorter the time frame, well, you're going to have a very tight hook on this. Of course, if you're looking for a daily, you want to have a lot wider range. Now, obviously, this is very wide. But one of the things that I talked to one of the gentlemen, and we'll get to the cash dollar index, but let's look at the euro on the daily. Someone was asking in the room, might have been Brad also, I think he was asking someone, he said, hey, what's y'all's line in the sand? Well, on the daily, now remember here, where's the 1283? Well, it is there, but you can see it doesn't have as much significance on the daily. The daily is more important here at the 1326. And I'll give you an example. Like today, we had our bias chart support at 1326. The market at the time, I think it dipped down to 1319 and held that 1326 I said was important on the daily. And I myself bought it. I mentioned on the webinar, I go, hey, I think about 3 minutes after the webinar started, well, I made a reference to it. I'm long the euro. I'm long the euro. And I picked it up. It was trading right there, right when we came on the webinar. And that was our bias chart analysis that we have here for ForexAnalytix. And generally, I'll have a little bit longer explanation or whatever, but this one was pretty simple. Euro consolidating support is 1326 followed by 1294. So it came down to 1326. It overshot it by just a little bit. So I said, hey, look, that's good enough. That's where the analysis was. And we saw a rally off of that from 1326 up to 1360. I didn't hang on all the way that long. But I'm saying as we rotated lower, I'm thinking, okay, now the euro's going to try and make a stand to hold against this 1326. I'm more comfortable holding it from a longer term perspective, and I'll tell you why. Now we'll go into the cash dollar index. And here's the cash dollar index. So one of the things I was referencing to one of the guys in the room, somebody else, we're talking about the cash dollar index and saying how the euro is so weak and so forth. And I said, yeah, but one of the things you have to look at, some of the big gyrations we've had in the cash dollar index, okay? And I told him over the course of the last 2.5 months, maybe longer here, and now that took a lot more time. But look here, you get a rally up here, you fall down pretty quick, everything looks all terrible, and then you rally right back, everything looks all bearish, then quickly, ding, 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 everything quickly in a short amount of time. Look how long this much time was before it fell. But look at this. Now we start to see some intensity with these swings. So you come back up, we're holding. We're not sure what the dollar is going to go and do. So it moves to new highs and looks like, hey, we're on our way. We're up and away. Blue skies ahead. And we quickly fall back. Okay, not as much we fall back. We rally back up. Oh, we're gonna get to new highs. We're holding. We really trapped a lot of bears, and then all of a sudden, wham! We had a pretty good fall here. You see that? Then we turn around and we rally, pretty good chunk of change back up, and then all of a sudden, wham! Look, here's the deal. The market shouldn't be doing this, and the reason is, I'm saying if it's bullish, you shouldn't seeing these big moves lower. My thinking is, and like I said, I've been bearish the dollar over the course of during this whole time. I've been bearish right in here. And my whole thinking was because the data keeps getting worse and worse and the Fed's going to cut. The Fed is already going to cut for what they consider an insurance cut, okay? But the thought process is they're not going to do 50. They're just going to do 25. But the concern is the Fed never does a one and done. You generally run into a cycle. Right now, we come in from the G20 weekend. We didn't start out strong like this. We started a little bit better, but not strong. But what was the catalyst? The Bunds, because we're seeing these rates really starting to slide on the German yields, which weakens the euro, which has pushed the dollar index higher. Now, if we opened up on Sunday here, or maybe let's say 20 pips lower, and kept on pushing, you'd say, hey, you know what, there's something behind this. Right now, to me, I think you got the guys on the bulls on this side. Hey, they're in control of the market. We're coming them off of a weekend, an event, and hey, you know what? They're putting the shorts feet to the fire. The same way with the Euro bulls. Hey, look, last week you were hang on a moment. Last week you were sucking wind. Look at this. Boy, I mean, Euro Bear, your name was mud. You see what I'm saying? You couldn't buy a break against this euro to save your life, okay? Now, all of a sudden, I'm hearing all these people that, and there are some in the room that have been, you know, they're bullish the dollar, but I'm seeing something, boy, really puffing, you know, people puffing up their chests. Oh, look, well, the euro's going to parity, blah, blah, blah. Well, you know what? I didn't hear parity on the way up here when the euro turned around and rallied, you know, nearly 300 pips or 250 pips. But my point being is that you're getting these swings, and my concern is one of the things that we're looking at going forward is with the cash dollar index is one of the reasons the cash dollar index had done so well is because it was the one central bank that was diverging. Okay, so even when the dollar would get to certain key levels, it just kept coming back up, come back up, come back up. Because one thing you could say was, hey, look, here in the States, we're raising rates. Now, finally, eventually, you'd say, you know what, well, we're not raising anymore, but we're holding our own while everybody else is finding ways to go on and find additional stimulus. Now it's starting to turn the other way around here as we're starting to see data coming in very bad. I've been mentioning this. One of the reasons, like I said, I'm not saying this as of today. I've been saying this from here, and here, and here, and here. When we had just this last month, when we had the manufacturing PMI, the worst since 2008, Empire Index just came out last Friday, the biggest fall on record. We've seen continuous slides. The difference is now, look, the dollar index opened higher, but we didn't get the spring. Was it dollar generated? No, it came from the bund, which the bund, like I said, is going to new all-time lows, which is pressuring the euro lower. A lot of people are long the euro. I myself, like I said, I bought the euro on the way back down. And now, as we see lots of times on Monday, you'll see a market come back down and really pressure them pretty good. We're in a pretty key area here, this 1285. When you look on the daily, as they say, no bueno if we go on and get below 1262 on a daily basis. But you know what? We've seen this happen a lot on Mondays where you see a market and it really, you know, you see a market come back, whether it's correct or moves higher or whatever, and boy, the pain is on, the pain game. And so you have to kind of take a look at this and see. And we did see where we had these little dojis here, medium-legged dojis, which generally when you see a medium-legged doji, generally what happens is you'll see the prevailing trend then going and pair back. But it looked like we only paired back a little bit and then reassert ourselves. Well, we're seeing more pain, so it'll be a little bit longer haul. I think that it's not so much that I believe in the euro, it's that I think that once the Fed does cut and the data continues to come in weaker, the same way that the dollar was so bearish and then went bullish and then went back to bearish and then back to bullish, is that we'll see a further grab into this thinking that the Fed may end up doing more than 25 basis points. Do they do 50 now, or do they do 25 the next meeting and another 25? Because nothing's been resolved with the China thing. You see what I'm saying? They've just delayed what we've already had. Okay, that'd be fine if the data had been going really great all the way up until what, 2 weeks ago or 3. No, the data's been getting continuously worse over the course of nearly 3 months. That's why if there's no resolution, which we didn't get a resolution, then the data will continue to go on and get worse. Now I can see what people are saying, how can you cut when the S&Ps are all-time highs? I see the point, but what they're doing is they're looking at the conditions of all the different reports that we have coming in, whether it's manufacturing data, regional district data. It keeps coming in weaker, including employment data. And I think the employment data for ISM was a little bit better this time, but we saw a fall, remember, the last NFP. So once again, that's where I think we are now. This isn't, doesn't feel good to be long and have the market pull down like this. But to be quite honest, it's not something that's unusual that we don't see already on a Monday. Now let's go and take a look here with the Aussie dollar. We do have the RBA, I think it's tonight. Hang on a moment. I can pull the data here. Hold on. There's it tomorrow. Hang on. I think we did have the RBA for tonight. Hang on a moment. Could be wrong. Apologize on that. But let me go on and push this back here. Been pretty busy this morning, so I do apologize. Let's see. Okay, so we already seen a pretty good fallback here in the Aussie dollar. And here was our analysis through the weekend. The Aussie finished the week at its best levels, but major resistances at 70.27. Beyond the 70.70, a pause is likely in order with support coming in at 69.60. Well, folks, we're at 69.58. Okay, a daily close below 69.23 would open the door for a challenge to new lows. So here's that 70.27. I've talked about it so many times. Sound, as my mom used to say, sound like a broken record. I said this 70.27 has been a key level since Moses crossed the desert. And it has been for a very, very long time. You can see that. It's been huge. Once again, like Brad had asked in the chat room, what's the significance when you put it as at the thickness? Well, you can see the thicker is, you can see how key this is. And this isn't on a 15-minute or an hourly or 2-hour. This is a daily chart. Look how far, how many times it hit at that 70.27. We did overshoot it a little bit, just a hair. Our bias chart resistance for Thursday and Friday was 70.13, so we overshot a little bit, but came in. We're looking for, pullback, a pause, what we call a pause to 69.60, and lo and behold, here we are at 69.58. So we'll see how that plays out. But one of the reasons is that why I think that it's difficult to be selling the S&Ps, now we're coming off a little bit, is because with the thought that the Fed will be cutting rates. We'll be going and cutting rates in July. They're not looking at the equity markets. They're looking at the continuous weak data that we've seen. Looking here at the dollar yen, we're still holding up rather high up here at the dollar yen. When we go in and we'll take a look here on the daily chart real quick. Oh, we've seen a pretty nice little run up here in the yen, here on the daily. Now, we did put our analysis, and let's go and look in here. Coming into from the weekend, we said the dollar yen, after reaching its target of 676, is now working off an oversold situation. Pair remains bearish with an upside resistance at 858. Well, today the high was 854, so not bad. As the analysis is put in for the subscribers here at ForexAnalytix over the weekend. So this was even before we even got to the Sunday session. We're looking for resistance coming in at 858. The high here was 854. So I think we'll still see this in time paired back, but the market is working off this oversold situation. We are seeing the dollar index, the Canadian dollar, come back. I had been long the dollar CAD. I actually jumped out at 31.17. We've actually pushed a little bit higher. I wasn't a believer as to how far the dollar index would go, and the dollar CAD had been a little bit of the weaker sister. So it probably would have been a good idea if I had held on for a little bit longer. But my thought was, hey, look, at that level, I wasn't very comfortable with holding it. Obviously, hey, look, got to hand it to the dollar bulls. You can see this 1285 is holding here for right now, hand the euro. Got to hand it to the dollar bulls. Hey, look, they've got control of the ship. Hey, and that happens on a Monday. Last Monday, the euro had the control of the ship. So, it goes back and forth. But my thinking is looking further out, which isn't that much further out. It's only a few weeks out, is that the Fed will be cutting. And as the data comes in, the Fed has already said they will be focusing more on the data as it comes in. Further scrutiny because of the data that's been in the rearview mirror has been continuously weak for 3 months. So now they're going to create or focus a bit more scrutiny on what's coming in. So every piece of data that comes in, that much weaker, puts more of a drag on the dollar. Now, right now, like I said, even though the data wasn't great, with Boons hitting all-time highs as far as price and lows as far as yields, has really put a world of hurt here on the euro. We'll go on and take a very, very quick move here into the cross rates, and then we'll just go on and jump on out. And you can see here that the Aussie yen opened up pretty strong here in Asia, and then we quickly started dipping back. We had already had a pretty nice run here. Sterling versus Yard, we're still, stuck in the bottom over here. Not really so much the bottom as we've come off against this top. The one that's really stuck in the bottom has been the guppy, which if you look at it on a 30-minute chart, it looks like it's come quite a ways. But when you look at it in the course of a daily, you can see this mark, or even a 2-hour chart, you can see this market has really been going south, 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 like a submarine honking the horn, going further below the ocean. We are a little bit of trouble here with the gold market. I was looking for 1390 all last week. We did get 1390. I got long down here. And once again, I'm comfortable with being long because, like I said, overall, I do expect the Fed to go in and cut rates. So you could make a point to the dollar. Look, I've been tracking gold for a while, although I haven't traded in some time. But I made cases for why gold was going to move higher back in December and in February and later on. And always the cases were either with the equity market or with the dollar. Gold did move to a certain extent each one, but gold really moves on rates. And that's why I believe that we'll see with the Fed. So the expectation that the Fed will cut is what sent the gold market, at least on the spot, all the way up to 1339. We've seen it come all the way back. 1439. I was looking for a move to 1390. We got that. We're under pressure right now, but I think in the long run we'll be okay. Well, that's all we got for today. Thanks for joining us here, and good luck trading.